Pompous
wants to chime in. Thank you.
All righty. Well, thank you very much for that wonderful introduction. For those of you who don't know a lot about me, there's really only three things you have to know about me. One is that I do have my own law practice for the last actually 40 years now. I got to update that biography. Since 1980, October of 1980, I have been slogging away working for entrepreneurial companies and their investors, venture capital firms, startups. During the 90s, that's number one. Number two, during the 1990s, I was the host of the first ever Shark Tank TV show. It was called Money Hunt. It ran on public television from 1994 until 2003. And it was not quite the same show as Money Hunt, as Shark Tank. Rather, we didn't actually make investments in people. We didn't, shell out money on the show. It was more of an educational show. We would have an entrepreneur come on, talk about his business plan. We'd rip him to pieces. And then from behind a curtain, we would bring the Money Hunt mentor, who was a leading figure in that person's industry, who would then tell them how to do the right thing, how to get things on track and how to build this to the next level. So you think about it, you have a little niche software product, you've just had your guts ripped out on live television for 15 minutes, and out behind the curtain comes Steve Ballmer of Microsoft, who's going to tell you the right way to do things. It was kind of a cool show. I mean, it was public television, so we had to have this educational component in the show. We couldn't do all the crazy things that they do on Shark Tank. But it was a lot of fun. It's my footnote to TV history, my 15 minutes of Andy Warhol fame. And then the third thing is I have written a bunch of books, and most relevant to this topic, I actually did a book back in 2016 it's called The Crowdfunding Handbook, and it has been widely touted around the world as the Bible for U.S. Crowdfunded offerings. So I'm very, very proud of that. I'm in the process of updating it right now. Some of you know there were some major changes last year, which I'm going to talk about in a few minutes, in the whole crowdfunding universe, which is dramatically impacted. The trouble when you write law books is you got to keep the bloody things up to date all the time. And contrary to what you may have heard, the life of a law book editor is not nearly as glamorous or exciting as it is portrayed in the media. It is actually quite a dull way to earn a living, but that's okay. That's why I do these programs, actually. It keeps me awake from time to time. These are all my disclaimers. Any of you who doubt that I am an attorney, this will prove it. We always tell you what we're not going to do before we tell you what we are going to do. Just so you know, this is a workup of a mock-up of a program that I did about 6 months ago for the New York State Bar Association. So you will see references to NISBA throughout this program. Since we do have a few lawyers on the line, I just want to point out to you that if you're looking at my slides and you will see, I'll try to see when I get into the program if I can view the notes page, but if I can, you'll see that I have citations to all of the things that I talk about, but they're in the notes page. They're not going to be in the text, and I apologize for that. I want to do one more disclaimer, a sort of an unusual one. I know more about some of this stuff than I do others. I wish I could say I was an expert on all things fintech, but I'm really not. I can't really say that I am. In the area of crowdfunding, I would consider that one of my A areas. I do a lot of work in that space. I also have worked in the field of coin offerings. But when it comes to things like cryptocurrency and non-fungible tokens and some of the other stuff we're going to talk about this evening, all I really know is what I read in the papers, although I do probably read more than most sane people do in this area, because I do have clients in this area. I do represent a couple of fintech companies. I represent some blockchain consultants who are working in the cryptocurrency field. So this is where my knowledge comes from. It's from the bottom up, not necessarily from the top down. So let's talk about crowdfunding just for a minute. Just the basics for those of you who are new to this. Crowdfunding is basically raising money from the masses, from the crowd. Believe it or not, the very first crowdfunding project was the base of the Statue of Liberty in New York Harbor. I mean, everybody knows that the statue itself came from France, but what a lot of people don't know is that the base that the statue sits on, the city of New York was supposed to provide the funds to make that happen, and they went bankrupt in 1883 during one of the so-called panics. Back then, recessions were called panics. The Panic of 1883 devastated the city of New York. The city ran out of money, and the New York Sun, a newspaper of that time, did a big full-page thing saying, this is a disgrace. We owe the French people more than this. They've done their bit. We have to do ours. So they basically pitched the first ever crowdfunded offering to to raise money for the base of the Statue of Liberty, and that's how the base got built out on what is it, Liberty Island or whatever it is, Randall's Island or something like that. I never remember the name of the island. I know it's not Ellis Island. That's where all of us came from. The statue was on another island. Okay. It's basically historically it's for a project of some type. Up until very recently, you couldn't do crowdfunding for a corporation or a business. If you were doing crowdfunding, it was to raise money for a project, such as an invention. Duh. I know there are some members of IACT who have raised money for their inventions this way. I've met them in some of the prior meetings before the pandemic. A book or other creative project. So, for example, if I wanted to take 6 months off to write my next bestseller, seriously, I've written 16 books. I'm just finishing number 17 right now. I would trade all of my royalty statements for just one of Stephen King's. That's it. I'm not greedy. Just one of his, I would be happy with. Okay. Really, seriously, I'd be very happy. Those 16 books, the royalties are nice, but they don't really add up to a whole heck of a lot when you write law books and other technical topics. Although the law books actually do quite well. I actually do quite well with that stuff. A surgical procedure not covered by insurance. One of my favorite stories of crowdfunding was in the very early days of Kickstarter. Somebody did a campaign. They were looking for funding for infertility treatments, which at the time were not covered by medical insurance. I think they're still not. And basically, the thing was, if they reach the desired amount and she conceived a baby, the crowd would be given the opportunity to name the baby. They would give them 5 male names, 5 female names, and whichever, and the crowd would basically decide what the baby's name was. I do not know unfortunately, I do not know what happened to that crowdfunding. I lost track of it years ago. I don't know if it probably didn't raise them the desired amount, probably is what's happening. Basically, when you do a crowdfunding, you launch a campaign on a crowdfunding portal. The two best known are Kickstarter.com and Indiegogo. There's quite a few others. And then you promote it aggressively on social media. There are 3 types of crowdfunding. Project crowdfunding, we just talked about, which is where you're raising money for a project and the investor gets something in return eventually. So if I were raising money via crowdfunding for my latest book, I would probably do a tiered set of what's called a tiered TIERED offering. So for $100 contribution, you get an autographed copy of the book. For $1,000, you get an invitation to the launch party for the book, where you might meet some celebrities or at least a whole lot of lawyers. And for a $5,000 contribution, I would come over to your house and babysit your kids so you could have a date night. I mean, this is kind of what project crowdfunding is all about. You don't get money back, you get something tangible, maybe. So for example, if you're doing an invention, you might get give people a copy of the prototype or something like that, or an actual copy once it's manufactured in China and it falls apart and does all that kind of stuff. Gift crowdfunding is the second type. A lot of nonprofits, 501c3 organizations use this type of crowdfunding, and basically all the investor gets is a warm fuzzy feeling, maybe a tax deduction if the organization is exempt from tax under Section 501c3 of the Internal Revenue Code. You can get a tax deduction. Otherwise, you can't. Beginning in May of 2016, we now have equity crowdfunding, which is what I'm going to be talking about tonight. Raising money for your business and offering actual securities, stock or debt, a percentage of the profits and losses from the business in return. A little bit of history. Crowdfunding was created in 2012 by the Federal Jobs Act, the Jumpstart Our Business Startups Act. Note the acronym, by the way. This was not designed really to help entrepreneurs. It was a job creation act. That's how the government looks at it. Basically, it made several changes to our securities laws. The federal securities laws date back to 1933. They were part of the New Deal legislation that FDR created, and FDR passed when he was first elected president in 1932. Created the Securities and Exchange Commission, and these were probably the first major changes to those laws since 1933. And there are 3 types of crowdfunding. We call them Title II, Title III, and Title IV, after the various titles of the Jobs Act that created them. Title II allowed for private placements to accredited investors only using general solicitation and advertising. Title III is the section of the Jobs Act that created the crowdfunding portals, and what I'm going to be talking about mostly tonight. Title IV expanded an SEC regulation called Regulation A, which is kind of a mini watered down public offering. But it totally jump started Regulation A. Regulation A is now the way that most real estate offerings of securities are being done, like office buildings and other major construction projects are being funded this way now via Regulation A. The most important thing that it did, though, is that if you're doing an offering under one of these three titles, it preempts regulation at the state level. In this country, both the federal government and the state government have the ability to regulate securities. And for many years, this was a major obstacle to capital formation in this country, because you not only had to comply with all the federal laws, you had to comply with a Byzantine array of state laws that varied very widely from state to state to state. I remember as a young attorney, I was one of 20 new associates that were hired out of law school to work at a very big firm in Manhattan. And each one of us was given two states. And every time the firm did an offering, our job was to get that offering cleared in our two states. Mine, I will never forget, were Wisconsin and Minnesota. Those were my two that I was given. I had the upper Midwest all to myself. Let's talk about the three titles quickly. There have been some changes to these recently, which I'll talk about. Title II of the Jobs Act. This Title II relates to private placements. Up until the Jobs Act was passed, if you were doing a private offering for an unlimited amount of money, you had to offer them only to accredited investors, and that's a defined term, and 35 other people. You had to make sure that the bulk of your people who bought the securities in the offering were accredited investors. And that's a technical term. It's defined in the SEC's Regulation D. That's the regulation that governs private placements. Basically, an accredited investor is someone who doesn't need the protection of the securities laws. It is someone who is either very rich or very sophisticated, or both. So, for example, the managing director of Morgan Stanley, whoever he or she may be, or Goldman Sachs, they just changed recently. Mr. Greenberg is no longer heading up Goldman Sachs. Can't remember the name of the new person. But that person does not need the protection of the securities laws. That person lives in the securities industry 24/7, 365. They know more than anybody about investing in offerings. They don't need the protection. The securities laws are basically consumer protection laws. Their job is to protect Clem Caddill-Hopper and his spouse from being ripped off by unscrupulous promoters trying to sell a piece of the Brooklyn Bridge. That's basically what the securities are. Look at them as consumer protection statutes. An accredited investor is someone who doesn't need that protection. Either they're very sophisticated, they're an investment banker, a company founders are considered to be accredited investors because they know more about the company from the inside than anyone else, or they're very wealthy. Basically, these are people who have either a net worth of more than $1 million exclusive of their house, or have an income of over, I think it's $100,000 a year, jointly with their spouse. It's not low income folks or middle class folks. It's the 1% is basically what you're talking about. Now, in 2012, the Jobs Act added Title II, and it added Rule 506C. Now, basically, what this did is it did away with what we call the 35 bad investor, the 35 bad basket limit. Up until this point, if you were doing a private placement for an unlimited amount of money, it had to be strictly accredited investors and up to 35 people who were not accredited investors. They gave you that little leeway. So if you thought that someone was an accredited investor, but it turns out they really weren't, they fell below the income or net worth thresholds, you were okay. You could just throw them into what we call the 35 bad basket, and you were okay. 506, but one of the conditions of that rule was that you couldn't use any means of general solicitation or general advertising. You couldn't take out a full-page ad in the Wall Street Journal saying, "Hey, we're offering 20% of our company. We're offering convertible notes, and here's the terms of the offering." You couldn't do that. If you did, it blew your exemption. You had to register with the FCC as an initial public offering or an IPO if you wanted to do that sort of thing. 506C, though, changes the whole ballgame. It says you can offer securities to an unlimited number of accredited investors in an unlimited amount and use general solicitation or advertising to reach them. This is a major, major change in our securities laws. But there's a catch, as there always is. Every single investor who buys into your offering must be accredited investors. If you, the 35 bad basket has gone away under 506C. If you make one mistake, you're toast. You lose your exemption. And if another exemption is not available for the offering, you have to register with the SEC as an IPO, which is a very expensive and time consuming process. The rule also says that you can't just rely on an investor questionnaire. I mean, people in private placements have been doing this for years. They send you a questionnaire, you check all the right boxes, you send it in, and as long as you check the boxes right, you're an accredited investor. That's the end of the story. Not the case here. They require you to do diligence. You can't just rely on the questionnaire. You actually have to look at the investors' tax returns, brokerage statements. People do lie about whether or not they are accredited investors, and also people's fortunes change. You know, this year's accredited investors may be next year's pauper, depending on how the economy goes and what they invested in. So this is 506C. The old rule still exists, and 50C has not been as popular as it could have been because of that limitation to accredited investors. A lot of companies still prefer to do their offerings under the old rule, which is 506B, which you can still do. The old rule still exists. You just can't use general solicitation or general advertising. So now let's talk about Title III. This is what I get excited about. This is what I wrote my book about. Title III of the Jobs Act added a whole new section of the securities laws. And basically what they did was they took the friends and family offering that we're all familiar with and took it to a new level. The SEC created Regulation CF for crowdfunding, and in 2016, which is what my book was all about. We actually got the book out into the bookstores the week after the statute became effective. We were the first book in the marketplace on crowdfunding. I'm very proud of that to this day. One of my major achievements. The crowdfunding was passed in May 2016. It was amended just last December of 2020. So some of these numbers are new. Issuers can raise up to $5 million over a rolling 12-month period via specialized gatekeepers called crowdfunding portals. These are specialized websites that are registered with both the SEC and FINRA, the banking regulator, the Financial Regulatory Authority in Washington. They have to register with both. And these people basically, you basically post your offering on one of these portals. The portal creates a page for your offering. You put all your offering documents, your pitch materials, and everything on that site. And then, to a certain limited extent, you can promote your offering to the crowd and have them invest in your company. There is little or no regulation at the state level. One of the conditions is that all communications with advertisers and all advertising must be conducted through the portal. You cannot just send blank emails to everybody. Well, you can do one. They will let you do one blast email to your social media crowd saying, hey, we got this offering. We're looking to raise $1 million to do X, Y, and Z. We're looking to sell 10% of our stock. You know, you can do that, but only once. You can't, you cannot continually talk. Any communication with investors has to be through the portal. There is no limit on how much accredited investors can invest, and people other than accredited investors can participate as long as they don't invest more than. Now, one of the unfortunate things is these limits go back to May 2016 when the SEC raised the investment limit. The investment limit used to be $1,070,000. Up until last December. And the reason for that 70,000 is because of inflation. These numbers are adjusted for inflation every year, which is why they look a little weird. They're not round numbers. But people other than accredited investors can participate. And these numbers have not changed last year. They really should have increased these as well, but they didn't. The SEC did not do that. So these numbers are still the same. They can't invest more than $2,200 or 5% of their net worth or annual income, whichever is greater, in crowdfunded offerings, not just this offering, but all crowdfunded offerings under Regulation CF, if their net worth and annual income are both less than $107,000. There's actually been some criticism of this rule. Believe it or not, a lot of people think that this is too big. You say $2,200. God, that's nothing. But there's actually been this rule has been critiqued a bit because it's too much. Think about it. If you're only making $100,000 a year, 5% of your net worth, that's $5,000, but that's 5% of your net worth or annual income in highly speculative securities you're investing in. And there are a lot of people who think that this is too liberal, that the SEC ought to reduce these numbers, especially for low income people who cannot afford to lose their money in speculative securities offerings. If their net worth or annual income is 107,000 or more, they can invest up to 10% of their net worth or annual income in whichever is greater, in crowdfunded offerings, and they cannot invest more than 107,000 total in crowdfunded offerings. Again, if you are not an accredited investor, if you are an accredited investor, these limits do not apply. You can now spend all of your income on crowdfunded offering issues. So who's taking advantage of this? Well, contrary to what you might think, tech startups are not really taking advantage of regulation crowdfunding. And there's a very good reason for that. If a tech company is getting off the ground, at some point, they're going to be looking for traditional venture capital. And a lot of people, lawyers and accountants, and financial advisors like me, brokers, are telling these people, do not do a crowdfunding for your company, because if you do, you're going to end up with a couple of hundred of investors owning like 10% of your company, and venture capitalists are not going to like that. They're not going to want to share their investment with all of the hoi polloi who invested in you in the crowdfunding. And unfortunately, the venture capital industry has been slow to adopt crowdfunding in a big way. They want to continue doing business the old way. So you don't see a lot of tech startups doing this. What you are seeing, and I predicted this actually in my book. If you read my book, I called this. The people there are two types of company that are taking advantage of equity crowdfunding under Title III. Companies that are, well, actually three types of companies. There are companies in retail, service, food, or other types of businesses, not tech, that historically have not been able to tap the equity markets because venture capitalists weren't interested in those kind of companies. But now they can tap into the equity capital markets for the first time. Beer and liquor is a big factor here. Virtually every craft brewery in the United States of America has done a crowdfunding in the last 5 years since the SEC adopted Regulation CF. Entertainment, games, some medical devices, one-off medical devices, and here's why I'm talking to you, inventors with tangible products. If you invent a new kind of spork, a spoon and fork for salads or something like that with a new design, a patentable design, you can do crowdfunding for that and actually raise money, and have it be part of a company. That's the kind of thing that venture capitalists don't care about. They don't look for those kinds of investments, but those are the kind of things that have been availing. So the second type of company is a company with large followings on social media that they could pitch to. So let's say, for example, you are Francis Tavern in New York. Some of you know this. This is a very famous restaurant in Lower Manhattan. It's where George Washington said farewell to his troops at the end of the American Revolution. It's one of those historic places in the United States. It's the kind of place that you only eat at when you want to propose to your future spouse or celebrate a 50th anniversary or something like that. It's a big thing for special occasions, kind of like what the Four Seasons was in Manhattan before it closed a couple of years ago. Well, Francis Tavern is a great place, and the food is terrific, but it's a restaurant at the end of the day. Venture capitalists do not invest in restaurants. I mean, Francis Tavern will never qualify for a venture capital offering. If it wants to raise money, traditionally it gets it through banks and mortgage loans and stuff like that. But what Francis Tavern does have is a very large presence on social media. They've got upwards of 1 million likes on Facebook. They've got over 50,000 Twitter followers. If you look up Francis Tavern on any of the major social media sites, they have huge social media followings. And what crowdfunding allows you to do, if you have a large social media following, you can tap into those people and ask them to invest in your company. I'm actually working. I'll tell you about this in a minute. So if you have when I'm looking at a client that's looking to do a Title III offering, one of my first questions is, show me your social media profile. How popular are you on social media? Because that's going to be a big factor in your success. And now if you have, 100,000 social media following, um, a social media following, you, a big following on social media, crowdfunding is something you should look into because the investor base is already baked in to some extent. By the way, somebody pointed out in the chat room right now, and you're absolutely right. The income threshold for accredited investors is $100,000, $200,000 for a married couple filing jointly. And I apologize. I did that too quickly, and I apologize. That's for accredited investor. To my knowledge, the investor limits in Regulation CF have not changed in December of 2020. They're still rather limited for people who are not accredited investors. The last type of company is something called a wowie zowie company. That is not a technical term. You will not see that. Those of you who are lawyers, you will not see that in Black's Law Dictionary. Do not try looking it up online. You will not find it. It's strictly a Cliff Ennico term. But basically, it's a company with a very exciting story. Marketing allure, sex appeal, pizzazz, maybe founded by a celebrity with a huge social media following. That's not an accident. I'll give you an example. This is something I'm actually working on right now. I can't mention names, of course, but I'm actually working with the managers of a very famous rock band from the 1970s. It's a name, if I mentioned it, you would have heard of them. They are looking to do a crowdfunding. They're setting up a special purpose company and they want to do a crowdfunding to raise money for a jukebox musical on Broadway based on their music, on their song catalog. Now, it's a band you've heard of. Obviously, what they're looking to do, they've got millions of social media followers, and they feel they need to raise $5 million, to launch the Broadway musical. Obviously, this has gone nowhere the last year because of COVID, but now with the theaters planning to reopen in New York in September and October, the Broadway theaters, they're starting to dust this off now, and the deal is coming back to life. They're looking to raise $5 million, and with over 1 million social media followers, they should be able to do that without having to go to the general public. That's the big thing about crowdfunding. Right now, one of the biggest limitations of crowdfunding is that there aren't a whole lot of people out there looking for crowdfunded offerings. You and I are not spending time online looking at crowdfunding portals saying, "Hey, what's new this week?" Oh, really? A rock musical? Oh, I'm into that. Wouldn't you love to say that you're part of a Broadway musical? That you're one of the angels who funded a Broadway musical. That's what I mean by a wowie zowie company. Something where you look at it and say, "Oh, wow, that would be so." I just want to tell I don't care if I don't make money. I just want to tell my friends I own a piece of that show. That's what I mean by a wowie zowie company, where the attraction is entirely visceral, entirely emotional. Let's look at some statistics. Title III, this is as of December of last year. And again, if you want, I can share with you some of these slides with the notes. This is not really a legal presentation, but if right now you don't have the benefit of the notes, so you can't see my citations and I show you what all my sources are. Look at these numbers. From 2019 to 2020, 713 offerings in 2019, 1148 in 2020. Crowdfunding was a very big gift to the crowdfunding community. A lot of small businesses couldn't raise money any other way. They didn't get a PPP loan or an EIDL grant, but they were able to do crowdfunding. I will share with you, I work with small businesses and entrepreneurs. 2020 was one of my best years ever. Back in March of last year, I was thinking I was going to have to quit and go work for McDonald's or something. I figured, who's going to do entrepreneurial stuff in the middle of a global pandemic? Well, I wasn't right about that. Last year was one of my hottest years ever. I haven't been as busy ever as I was last year in 2020. And 2021 year to date is looking to be about the same. Look at the amounts raised between 2016 and 2018. Only 194 million was raised using Title III. That number dropped dramatically in 2019. A lot of people said, crowdfunding's on its way out. And I remember talking to some lawyer groups in New York and Connecticut, who said, crowdfunding, yeah, it was nice, but it's kind of a flash in the pan. It's not going anywhere. Look at the numbers for 2020, double what they were in 2019. In terms of amounts raised, there were 892, 900 of those 1,150 offerings in 2020 achieved their minimum cash raise. only 256 were not funded or removed. I mean, sometimes companies, these are all early stage startups. Sometimes they go out of business in the middle of the offering and they have to shut down and give people their money back. That's what that 256 is. Either they didn't make their minimum cash raise, or they had to remove themselves from the portal because their business model changed. The CEO quit or something like that. The average amount raised in 2020 was $225,000. This is not really a way to raise $5 million. I mean, the vast majority of the offerings that I see on Title III in the SEC Edgar database are between 500,000 and a million, or 250 and 500,000. This is where you get your seed capital. This isn't really where you get your growth capital down the road. This is no substitute for traditional venture capital. Issuers from just about every state in the union, heavy presence from companies in California and New York. Duh, that shouldn't be a surprise. Florida, it should be no surprise, is the third biggest state in terms of number of issuers. 48 companies that were launched in 2020 raised the maximum of the 1.07 million. Again, the new law that raised the ceiling to 5 billion didn't get passed by the SEC till 2020. So the old limitation was 1,070,000, which is why it's that. There were over 358,000 unique individual. This is to me, the most important statistic here. People are now aware of crowdfunded securities. In 2017, 2018, hardly anybody was investing in these things. Now, 350,000 unique investors in 2020 investing in Title III. Now, of course, a lot of those people were social media followers of the issuers. They weren't, people looking online looking for investments. That still hasn't happened. The average cost of an offering under Title III is somewhere between $5,000 and $10,000 on the low side. I mean, my fee is a flat $7,500 for handling these things, which kind of gives you an idea. To me, the biggest thing, and this only happened in December of last year, and I really want to follow it this year. One of the biggest limitations on crowdfunded offerings is that there was no secondary market for these things. Once you invested in a crowdfunded company, you really had no place to sell your stock, even if you held it for the 2-year Rule 144 period. You had no place to sell it to. A company called Start Engine, which is one of the portals, set up what's called, in December of last year, Start Engine Secondary, which is the first ever online market for crowdfunded shares. It's basically startengine.com/trade. TRADE, if you want to look this up. This to me is the most exciting development from last year in the crowdfunded universe. It plugs the biggest hole in the system. The one thing that was the biggest gap that was missing to make crowdfunding funded into a normal blockbuster way of doing business. This was one of the biggest handicaps, and I think this problem has been solved in a very big way. But I don't want to be premature here. This is something that's going to. This company only was launched in 2020. I want to see how they go. Okay. Now here's the slide you want to take a screenshot of. You're saying, well, gee, Cliff, what about the portals? Well, we got 64 portals now registered with FINRA. There's about 10 more that are waiting to be approved. So figure 75 by the time, this is a little bit out of date information. This is from 2020. These are the top 10 crowdfunding portals in terms of cash raised. WeFunder and Start Engine, you can see, account for the lion's share of these new offerings. Ad Republic, and you got pretty much 95% of all the new money that's being. It's a highly concentrated market here. People want to be on the portals where the investors are. This is going to be like any new industry. There's going to be a lot of startups, but eventually they're all going to get consolidated, and we're going to have a big three, just like the automakers. And you can see this happening exactly here. I'll leave this up a second so you can just take a photo of it. If you add .com after these names, you'll almost always get to their websites. But these are the hot companies, mostly in California. Seed Invest is in New York. I think Next Seed is also in New York. I'm not sure about that. Most of these are California based. Okay. I just want to say a word about Title IV, and then we'll move on beyond crowdfunding. Crowdfunding is really the heart of what I wanted to talk about tonight. In 1964, Congress adopted something called Regulation A. It was basically a streamlined public offering for companies that only wanted to raise $5 million or less. Now, in 1964, $5 million was a lot of money. Today, that's not so much money with inflation and everything else. Regulation A was kind of a backwater. When I was in law school in the late 1970s, Bob Marley and the reggae revolution was going on. So it kind of became kind of a joke. Oh, reggae, reggae. Yeah. Lawyers do not reach far for their humor. Okay, we're we're the ones who come up with the obvious puns. Okay, our sense of humor isn't always very creative, unless of course it's me. This has had a major impact, though. In 2012, um, the Jobs Act dramatically expanded what you can do under Regulation A, and it created two tiers. It basically, tier one is for securities offerings of up to 20 million in a 12-month period, and tier two consists of securities offerings of up to 75 million. It was 50 million, but that SEC release in December of last year raised it to 75 million. For offerings of up to 20 million, the first tier, a company can elect whether to proceed under tier one or tier two. So if you're looking to raise 30 million, but you think you're only going to get 20 million, you could do a tier one, but then change it into a tier two later on. They made it very easy for you to do that. The thing you have to remember is tier two offerings are exempt from state regulation. Tier one offerings are not. If you're doing a tier one under Reg A, you still have to comply with the securities laws of each state in which your prospective purchasers reside. So that's crowdfunding in a nutshell and what's going on. Bottom line is this: the news there is it's happening. 2 years ago, I would have said, well, I don't know. It may happen, it may not. But two developments, the pandemic and the SEC raising the limits last year, have made this now a viable way for a lot of companies to raise money, but still not tech startups. But for inventors looking to raise money for their inventions, for wowie zowie companies, for companies that have retail service business models, non-scalable models, but models that traditionally have not appealed to the venture capital community, you now can raise equity capital for those kind of companies using crowdfunding. Think restaurants, food delivery, service businesses. These are the people that are really taking advantage of this. Okay, shifting gears. Cryptocurrency is not one of my A areas. I'm not going to spend a lot of time talking about it, but you all know what I'm talking about. It's Bitcoin, Ether, Doggy Coin. Thank you, Professor Lyon, for telling me the correct pronunciation about it. I'm a fan of medieval history, so I would call it Dogecoin after the rulers of medieval Venice were called Doges, Doges. So nobody, of course, cares about medieval history. Is a great preparation, by the way, for being a lawyer. It really is. I always find that a lot of lawyers I deal with have an innate love of medieval history, but they won't admit it. This is just my prediction. I don't think cryptocurrency is going to be a new currency. I don't think so. I think it's going to be more like the new gold, or maybe a collectible. Maybe. Not so sure about that latter. I think it's going to be the new gold. There's a lot of similarities, what I'm seeing between the way cryptocurrencies behave and the way gold behaves in the marketplace. It does, like gold, it does not generate income. It's merely a storehouse of value and a vehicle for special speculation. It cannot be used to buy things just about anywhere, except maybe a Tesla. Elon Musk has said he will accept Bitcoin for Teslas. He will do that. But except for him and maybe one or two other manufacturers, nobody is accepting Bitcoin. It's not being used as a medium of exchange. And also, let's face it, part of that is due to the price. With each Bitcoin now going for about $6,000, how do you make change? If I'm buying a wad of bubble gum, I'm going to need a lot of change from a $6,000 Bitcoin. They have to work out the denominations yet. Bitcoins are not truly coins at all. There's also increasing concern about the environmental and energy costs of mining. If you know anything about Bitcoin at all, these things cost a lot of money and a lot of time to create. They have to be digitally mined. I was reading an article in the Wall Street Journal last week that said that a lot of real estate entrepreneurs now are buying abandoned factory buildings here in New England and converting them into mining farms for Bitcoin. If you've ever seen one of the pictures of these places, you literally got hundreds and hundreds, sometimes thousands of computer servers all in one room or one building, all grinding away, calculating, solving mathematical puzzles so that a certain number of Bitcoins will be created each day, each week, each month, whatever. It's a massive investment. It's capital intensive as hell. It uses up a ton of energy, and it is not really very good for the environment. Those of you who care about global warming, Bitcoin mining is one of the is one of the biggest carbon dioxide producers you can imagine. It's almost like having a coal-fired power plant, and there's an increasing concern about the impact that cryptocurrency mining is having on the environment. Just last month, the People's Republic of China banned the use of cryptocurrency for purchasing goods and services. How can you have a currency that can't be used to buy anything? I just don't get that logic. Having said that, okay, I do have a prediction that's more on the positive side. Well, I don't think that cryptocurrency is going to be going anywhere, certainly not anywhere near, what Satoshi Nakamoto thought it was 10 years ago or 15 years ago when he first created this, whoever he was. He's a mystery man. But digital currencies backed by government, I do think are the wave of the future. Let's face it, why in 2021 are we going around carrying metal coins in our pockets? Why is that happening in a digital universe, or little pieces of paper that are disintegrating in our hands every day and are germ carriers, especially after pandemic? Are you going to look at your money the same way? I remember there's a hotel in San Francisco called the St. Francis. It's been around for over hundreds of years. It's like the Waldorf Astoria in New York. And I remember reading that back in the early days of the St. Francis Hotel in the early 20th century, like the 1920s, they actually had a service that would wash your coins for you, your pocket change. They would actually wash your change for you. Because it wasn't considered healthy, especially for women, to carry, dirty coins in their purses. And everybody wore silk gloves back then, right? They got filthy with the coins. That was a service that they used to offer. Well, after the pandemic, we're going back to that. I think in a very big way. Money is dirty. I think there's going to be an impetus to try to develop digital currencies. China has already started digitizing the yuan. They launched a pilot program last year on the digital yuan. It actually shows up on your screen with the picture of Chairman Mao and all that, just like a piece of currency does. The EU is looking into it. They've established a task force to try to digitize the euro within the next 5 years. I confess I do not know what the Federal Reserve is doing, but I understand they're looking into this as well. It's all very early stage, but there's no question digital currency as opposed to cryptocurrency is the wave of the future. Okay, I want to talk just a little bit. I think I'm limited to an hour. I might run about 5 minutes over if that's okay. I'll ask Professor Lyon if that's okay, because I want to get through this stuff. I actually have helped just recently a couple of my clients with coin offerings or ICOs, initial coin offerings. These are similar to project crowdfunding. This is not equity crowdfunding. These are crowdfunded offerings that are looking to raise money for a project, not for a company, and in which investors pay in Bitcoin or other cryptocurrency and receive in exchange a crypto coin called a token. Now, the token can mean anything. It's not necessarily a security. A token may represent a share in a firm. It may be a prepayment voucher for future services. It could be a coupon, or it might have no discernible value at all. What the investor is hoping for here, again, as with Bitcoin, is an increase in the value of the token, not necessarily an increase in the value of the company that issued it. It's a speculative vehicle. It is not, it does not necessarily follow the success of the company. Okay, and the transactions are reported on a distributed ledger or blockchain, and they may be freely tradable. That's what an ICO basically is. Okay, there we go. My thing's getting a little sticky there. Okay, most issuers are extremely early stage or concept companies. These are companies that are at the ideation stage of their development. Basically, what the startup does, it creates a plan or white paper, like a business plan, which states what the project is about, what needs the project will fulfill upon completion, how much money is needed, how much of the virtual tokens the pioneers will keep for themselves, what type of money is accepted, and how long the ICO campaign will run for. It's a project crowdfunding. Project crowdfundings are usually for limited periods of time, usually 3 to 6 months. It can be longer, but doesn't happen very often. In 3 to 6 months, you know if your offering is going to succeed or fail. So it's a project crowdfunding with Bitcoin or cryptocurrency at the other end. There are basically four types of tokens. Payment tokens are synonymous with cryptocurrencies. They have no other function. Um, you know, tokens may, in some cases, become accepted as a means of payment over a period of time, but there's no guarantee. A coupon token, so let's say a craft brewery, gives someone the right to purchase goods or services. So a coupon token might entitle the holder to a 20% discount on every case of beer they buy for 2 years, or something like that. That would be an example of a coupon token. Utility tokens are intended to provide digital access to an application or service. Some SaaS providers, software as a service, cloud software providers, are creating utility tokens and offering them to their best customers. And then last but not least, asset tokens represent assets, participations in real physical companies or earning streams. These are securities. Asset tokens are securities under the securities law of any country that I'm aware of. You can do hybrids. You can have tokens that partake of each of these particular qualities, and any token can be considered a security if it meets a country's definition of a security. The thing you got to be aware of if your clients or you are thinking about doing an ICO, you need to be crystal clear as to what the token represents and what rights the holders of a token have. Just calling it a token doesn't tell anybody anything. You have to be very specific. Here are the rights of the token, especially if you're worried about compliance with the securities law. If you are issuing a token that gives people the rights to a share of the profits or a share of the revenue for your company over the next year or 2 years, that's a security. And it has to be either registered with the SEC or you have to have an exemption, qualify for an exemption, one of the exemptions I talked about earlier. I apologize for the small type on this. There are 4 steps in an ICO. You prepare the white paper. You pre-sell tokens to your insiders. Most ICOs are done in 2 stages. You have a pre-sale, kind of like a private placement, to your insiders, your friends, your family, the people who've helped the company get off the ground. You give them the best deals, and then you launch the project crowdfunding to the general public and the hoi polloi. It's a 2-stage thing. There is something called a simple agreement for future tokens, which give the pre-sale investors the right to participate in the proceeds of a future sale. It's really incredible, the infrastructure of documents that is built up around these things. And then you do your crowdfunded, then you get the proceeds from the pre-sale, you execute the project, and at some point in the line, if you see that the project is actually going to happen, that's when you launch your tokens to the public, and they make their payment in cryptocurrencies. Most ICOs have a minimum threshold for funding, and if the threshold is not met within a specific time period, the offering shuts down and the money is returned to them, just like in an equity crowdfunding. ICOs are not very popular right now. The People's Republic of China banned ICOs in September 2017. I'm not sure that they've changed anything there. US and UK regulators have said the tokens may be securities. In the US, they apply the Howey test. Howey is a famous Supreme Court case from 1946. Listen to that date, 1946. It was a Supreme Court case which basically said that something is an investment contract if somebody's investing money, there's an expectation of profit. The investment of money is in a common enterprise with other investors, and any profit comes from the efforts of a promoter or third party. So those are the 4 criteria in the United States. If your token does these 4 things and meets these 4 criteria, then you've got a securities in your hand, security on your hands under the federal securities laws. And if it is a security, the ICO either has to be registered with the SEC as an IPO, or it must qualify for one of the Regulation D exemptions. Shifting gears for a moment, let's talk about non-fungible tokens. There's been a lot of publicity about these recently. Sotheby's just had an auction just recently of digital artwork where somebody actually invested something like $60 million in one of these things for a digital artwork that is utterly ugly. I have to tell you, they're saying that these are going to transform the art world. I'm not so sure about that, but let's say, first of all, say what they are. It's easier to say what they're not than what they are. A non-fungible token basically takes digital works of art and turns them into a verifiable asset. Think of the NFT as a certificate of authentication. And those of you who have ever bought an antique or something like that, or a highly valuable collectible like what is it, a 1956 Mickey Mantle rookie card or something, usually there's a certificate of authentication attached to that. And that certificate can be very valuable depending on who issues it. I actually work very closely with a company in Florida. The owner is a very, very dear friend of mine. He sells and auctions 1960s and 70s rock posters and other rock and roll artwork. And a lot of these things are autographed, and he personally is an autograph expert. If he's selling a 1969 Woodstock poster with a Jimi Hendrix autograph, and he has a certificate of authentication as to that signature, that certificate alone will probably quintuple the value of the item. Because there's a lot of forgeries of Jimi Hendrix signatures, as you can imagine. Basically what a content creator does, he creates a digital artwork and then he uploads them to one of these marketplaces. I'm giving you the URLs. You want to take a screenshot of this. To basically to create the NFT. The NFT is not created by the artist. It's created by these marketplaces, and they charge a network fee called gas for the privilege, for creating the NFT and for hosting the NFT on their marketplace. Right now, NFTs can only be sold for cryptocurrency, so the creator also has to open an account on Coinbase. Coinbase is the digital marketplace for cryptocurrency. In fact, it just went public last week. They just launched their IPO. And it's right now, you can only pay in Ethereum. You can't pay in Bitcoin yet, but I understand they're working on that. Then in theory, at least, the creator just sits back and waits for the digital payments to flow in the door as people buy their NFTs. So what's good about an NFT? Each NFT is unique. When you buy the NFT of an artwork, you own an original, just the same as if you bought an oil painting at a brick or mortar art gallery. Again, think of the NFT as a certificate of authentication, and you're of a collectible or artwork, and you're very close to understanding what an NFT is. Each person and sale of an NFT is recorded on a blockchain, which makes it almost impossible for someone to sell knockoffs of the artwork without getting caught. If someone is selling that same artwork and it's not tied to an NFT, it's a fake, it's a knockoff. Even though it looks exactly the same and identical to the NFT artwork. If your name does not appear in the chain of title, you have no legal right to that artwork. What you have instead is a copy, which may be an authorized reproduction. I'll talk about that in a minute, or an illegal knockoff. Here's what's really amazing about NFTs. And as a book author, I'm not an artist, but as a book author, I can really relate to this. The artist can include a smart contract with the NFT specifying that he or she gets a percentage of the purchase price each time an NFT changes hands. Now, that never happens in the brick and mortar art world. When an artist sells a painting at an art gallery or at an auction, that's it. They get their money and that's it. That painting could be resold 30 times. The artist never gets a dime or a nickel from the sale of the artwork. With a digital artwork covered by that's part of an NFT, they get money each time that NFT changes hands. That's going to transform the art world in a very big way. Now, the other thing that's good about it too, and I'll talk about copyright more in a minute. I have, by the way, those of you who don't know, I have a YouTube channel. I've got 53 one-hour videos on YouTube on any aspect of starting and running a small business or a tech startup. The one that's relevant here, I have a very good one on copyright. It's called Copyright Basics for Artists and Other Creative Types. If you go to YouTube and search for Cliff Ennico, if you search for Cliff Ennico, you'll get all of my 53 videos. But if you search for Cliff Ennico Copyright Basics, you'll get right to the one on Copyright Basics. It's about an hour. I think I may have actually recorded that for IACT a couple of years ago. That may be one of the talks that I gave for IACT recently. I don't remember now who I did it for. I do talks for a lot of people. Digitizing an artwork in an NFT is a terrific way for artists to prove their date of first publication, without having to go through the tedious and often inefficient process of registering a copyright. Why does an artist register a copyright for their work? The copyright attaches at the moment of creation, but you do it to get the date of first publication. It establishes that date. Anyone who's coming along saying, well, wait a minute, you ripped me off, you stole my artwork, they have to prove that that artwork was in publication or was being publicized before the copyright registration date that you have. That's a very difficult burden to prove. So it's a great way to establish the date of first copyright without having to go through the actual copyright registration process with the Library of Congress. What's bad about NFTs? Well, just like buying a painting in a brick and mortar art gallery, when you buy an NFT, you're buying only the artwork itself. You're not getting the artist's copyright, the legal monopoly that gives the artist to exclusive right to exploit the artwork commercially for a period of years. That artist is absolutely free to generate multiple copies of that NFT artwork. That NFT is not a copyright. It can be used to establish the date of publication for copyright purposes, but it is not itself a copyright. Okay. And the trick with digital artwork, you see, is that digital artwork or digital reproductions are exactly, virtually identical to the original. Now, that is not the case in the brick and mortar world. I mean, there are millions of reproductions of the Mona Lisa, and I'm sure there are tens of millions of seriographs, lithographs. I had a poster of the Mona Lisa in my college dorm room. You know, they've been around for years, okay, but it's not the original. The original, there's only one original. It sits in the Louvre. It's got Leonardo da Vinci's brushstrokes behind, on it. Nothing is, even somebody else who may have did a copy, brushstroke by brushstroke, of the Mona Lisa, there's still only one original of that artwork, and it doesn't look like anything else. You know, any reproduction is a lower quality than the original by definition. That's not the case with digital artworks. If I create a digital artwork and I make 50 copies, each of those copies is virtually identical to the other. There is, if you put them up, there's no way to distinguish between those 50 copies. So if you buy an NFT of an artwork and the artist is selling reproductions from his website, which is the original and which are the copies? Can you have multiple NFTs for the same work? These are questions that have not been resolved yet in the world of NFTs. NFTs are in their infancy right now. They have a long way to go. And last but not least, it isn't really clear at the present time how NFTs will apply to copyrightable works other than digital artwork. So, for example, works of literature, architectural designs, musical works. If I write a novel and post the text to an NFT, is the NFT merely the original author's manuscript that can be resold only as a collectible? Or if I add a smart contract claiming a percentage of each sale of the NFT, have I just self-published the book? Think about that. What does that smart contract that I talked about earlier do to a work of literature? If I get money every time the work sells, that's kind of like what a publisher does, right? And I get a royalty. That could be the future of self-publishing, is with NFTs. And what about the physical manuscript? Let's say I print it out. Which is the original? Is it the printed manuscript or is it the NFT version? NFTs create a lot of issues about authenticity, authorship, and uniqueness. Transferring this to the world of music, if I write a song and upload the music and lyrics to an NFT, is the NFT the sheet music of the song? Is it a recording, a live performance, or is it all three? The music industry traditionally distinguishes between publishing rights, reproduction rights, and performance rights. And there are a lot of other rights as well. If you want to know about this, there's a wonderful book called This Business of Music by a guy named Krasowski. It's a classic text. It's been around at least since I've been in law school. This Business of Music, that describes all the different kinds of publishing rights and rights within the music industry. But what is an NFT work of music? What is it, and how are the rights assigned within the NFT? Those are questions that all have to be resolved if the NFT is going to expand beyond the very limited world of digital artwork. There's some other cutting edge tools for people that are looking to finance their investments. There's something called royalty financing. I'm not giving you the materials that I gave to the New York State Bar Association, but basically that's a situation where you get money from people, and what they get in return is a percentage of the cash flow from your invention, the revenue, the gross revenue, or maybe net revenue that you get from your invention. It's a very popular way for a lot of startups, especially SaaS providers, to raise financing sometimes because they don't have any tangible collateral for their loans. There's something called the Simple Agreement for Future Equity, or a SAFE. Basically, the issuer agrees to give the investor a future equity stake if certain triggering events occur, but the exact number of shares is kind of left loosey-goosey. I'm not a big fan of the SAFE, and neither are most attorneys who work in this space, but a lot of people do it because it's too expensive to value a company when it's first starting up the ground, especially a company that has a tech product without a proven market. How do you value a company that has a technology but hasn't been marketed yet? That's one of the hardest things in the world to do. I don't think it's actually possible. So what the SAFE does is it kind of kicks the can down the road. It says you will get some equity down the road, and we're not going to be too specific about it, but how much it's going to be. But don't worry, it'll make you rich, and trust us, we know what we're doing. You kind of know what. That's why lawyers don't like it very much. The equity linked note, there's a wonderful Wikipedia article on this. By the way, all these things have Wikipedia articles if you really want to know more about them. Royalty financing, the equity linked note. There's no interest. The holder gets a percentage of the increase in the underlying equity. It's kind of like, if you're familiar with the concept of a phantom stock plan in corporate law, where the holder doesn't actually own a piece of the company, they just get the right to an increase in the value of the company year over year over year. That's kind of what an equity linked note does for an investor. And then finally, this is very popular in the franchising world. A lot of my clients who have bought franchises have done this. It's called a rollover as a business startup. Basically, you have a lot of money in your 401k plan that you want to invest in a new company, but you can't do it as a distribution, say, because you're not 59 and a half, and you get taxed to hell if you take the money out. What you can do is you can form a C corporation, roll over your 401k or some of it into a profit sharing plan, which the corporation has. And then the profit sharing plan buys shares in the C corp, which gets the money into the company, so you can pay the initial franchise fee, the build out costs of your smoothie palace, whatever it is. It's very popular in the world of franchising. Okay, so that's my overview of some recent developments in fintech. These are some of my books. The crowdfunding handbook is the one right above my name there. I also got some books, since we have some lawyers on the line too. If you know any young lawyers, I also have a series of books. I wrote them years ago and they're still published. Stanley Kaplan, Kaplan Publishing took them over years ago on how to make partner at a law firm, how to make law review. I have a book on how to interview for a legal job, which was actually my first book. Actually, I published that in 1989. It's still in print, 30 years later. I'm very, very proud of that. And then this is my contact information. There is where you can find out all about me and all the wonderful stuff that I do. I also have a website at cliffennico.com, which is strictly my law practice. This Succeeding in Your Business is all of my non-legal activities, and hopefully not any illegal activities in there. At least I hope not. So that's all I have to say about all this in a nutshell. If people have questions, you can post them in the chat room, or you can open your mic. Doug, I'll let you determine how this is best done.
All right. I want to thank you, Cliff, for a great presentation. I guess maybe people can post their questions in the chat, unless let's see how many people we have here. I think it's yeah, the group is pretty small. Maybe we could just open up our microphone and ask the questions. I got a question from you. For you. So I'm buying a cask of scotch, and I get a number on a certificate. Can I use NFTs to issue something that shows that I've got the scotch sold only once? Because I'm afraid somebody might have sold the same cask of scotch to 10 different people.
Yeah, this is the question. At what point do we have an original, and at what point do we have a copy? Now, let's say that we're talking about a particular thing that has a serial number to it. I mean, there are some limited single malt distilleries, especially in Scotland, that have limited edition scotches where each bottle has a serial number. Now, that's the kind of thing you might be able to do an NFT for, because the NFT is tied to that one specific bottle of scotch. But if you have a case of scotch with 12 bottles in it that are otherwise identical, and you do an NFT for like each bottle, do you see where the problem comes about? Which bottle is tied to each of those NFTs? I mean, scotch is a very bad example, but let's say baseball cards. Let's say I have a 1956 rookie Mickey Mantle card that's been PSA graded 9 or something in a slab. Okay, now that's a very specific item, and it has a serial number attached to it. I might be able to do an NFT for something like that because it's tied to that specific card. This is not tied to just any 1956. I think it's 1956. I'm not really a baseball fan. Was it 56 or 57 was Mickey Mantle's rookie year? It was one of the two. But I think it's 56. But it's tied to that specific card that's been graded by PSA. It doesn't apply to any of the couple of hundred rookie cards that are still floating around the collectibles marketplace somewhere. We really don't know. The NFTs are tricky. It's easier to say what they're not than what they are. What they are not is a copyright. It does not, if you buy a digital artwork with an NFT, you do not have the right to reproduce the work and sell copies. Only the creator, the artist, has that ability. That's not a copyright unless the artist has given you the copyright and sold the copyright independently to you. You do not have that right to make copies. He can still make copies, which I question what the value of the NFT is. If that's not the case, I mean, what does it say to say these 50,000 copies are all identical, but this one here, that's the original, and it's worth it? Not really. I mean, they're all exactly identical. That's the problem I have. The biggest problem, I think, with the NFTs is just what are they, and how do they apply to things other than digital artwork? That's the thing that the thing. I mean, somebody just posted to the chat room, great presentation. Thank you. And the nice thing is that NFT can go low or high. One of my favorite companies, Funko, is looking to do NFTs, if you know Funko Pops. And there's Top Shot, where you can buy a numbered NFT of a teeny digital video. Yeah, they actually did a video of, I think, was it LeBron James slam dunking a basketball? That was one of the things that was sold at Sotheby's, which is great, except that video has been up on YouTube now for at least 5-6 years. So if I want to look at the video, I don't have to go to the owner of the NFT and ask for permission. I can go up on YouTube and there it is, exactly the same video. So again, what am I getting with the NFT that is unique and distinctive other than, well, this one has the NFT and it's the NFT that you're buying and none of these other copies have the NFT? Well, what do I care about that? I mean, again, some people who know me know that a number of years ago I had a relationship with eBay. eBay sent me around the country talking to their sellers about legal and tax stuff, making sure they pay with their sales taxes, they comply with the sales taxes. Again, what exactly, again, and I'm very confused about this. People do fakes and forgeries, Beanie Babies, again, so somebody else commented, you don't, but somebody owns the numbered copy of the digital. That's why I'm thinking if something has a serial number attached to it, that is the kind of thing where you might be able to do an NFT, because that would apply only to that specific item that has a serial number. Two people do not own the same baseball card, although there are quite a few people who own 1956 Mickey Mantle rookie cards. But they're all different. Some are in poor condition.
Let me
condition.
give you a real example.
Mm.
So I'm buying a 50% ownership in an airplane, and it's got a registration number. Now I make an NFT for that. I put it on my alternative trading system. I know it's not a security because it doesn't actually increase in value. In fact, it depreciates in value the longer you own it. And by the way, it costs a lot of money to own an airplane. And it costs even more money to operate the airplane. And now I want to say, maybe I want a liquidity event. I want to sell half my airplane. I sell it on the alternative trading system, which I don't even have to register with FINRA because it's not a security. So now I've got a means of basically exchange and having a way to, let's say, exit from my ownership of my Ferrari or my airplane or whatever it is, my cask of whiskey. And now, in effect, I've created a whole secondary market for something that doesn't even have to be registered with FINRA.
That's right. Yeah, well, yeah, there's no question the 50% ownership of the airplane would not be considered a security. Well, let's put it this way. Unless, is it a charter? Are you chartering the airplane?
No, this is just I own a real
All right.
hard asset, which I decided maybe I'd buy it as a hobby, maybe I'd buy it as an investment, but who cares? It's not going to increase in value by virtue of anybody's effort. So it fails the Howey test, and therefore it can't be a security.
Unless you're chartering it. That's why I asked you if you were
Yeah,
chartering.
unless you
Because if you're chartering it, then
the
the income is being shared by the investors. That is
Sure.
a security. You remember the Howie case involved an orange grove, where the orange in Florida, where the orange grove owner was selling. He wasn't selling shares in the farm. He was selling shares, a percentage in the future crop releases. Basically, if you pay us so much money, you get 10 crates of oranges in the middle of winter each year, that kind of thing. And the SEC said that that was a security because you were relying on the growers to make that happen for you. Even though you weren't buying a piece of the actual company. I mean, Howie defended themselves by saying, we're not selling pieces of our company. That would be a security. We're just selling percentages in the future crops that we're going to have here. But the SEC said that that was a security. So you got to be careful with that. The airplane example is a very interesting one. The bigger question to me is, does the NFT create evidence of title? So if I go to you, around the back end, and you give me a piece of paper, selling me 50% of the the airplane, your 50% ownership, but you don't sell me the NFT, somebody else gets the NFT. Who owns that 50% stake in the plane for tax purposes? Who can get to take the depreciation on it every year? That's the more interesting question. And the law right now, again, NFTs are in their infancy. Lawyers are racking their brains trying to figure out what are these things. Is it a title instrument, like a deed, like a certificate of title to an automobile? Or is it a security? Or is it a certificate of authentication saying you've got the real one here? These questions are not resolved yet, but these are the questions that are going to have to be resolved if the NFTs are going to go beyond the very limited and narrow world of digital artwork. And even in the world of digital artwork, we have this question of, is the NFT assignment a purely arbitrary thing when you've got 50,000 reproductions out there that are exactly virtually identical down to the last pixel? That's the thing that I'm wrestling with in the whole field of artwork. Other than the fact that you have the one with the NFT on it, again, what does that mean?
Well,
Again,
today, for example, you can buy wine futures. And when you buy wine futures, you're basically buying something that hasn't been released to the public yet. And it could
right.
be, a very expensive thing, like $600 bottle of wine in a case. And then you buy like the whole case, or you buy several of the cases. And now all of a sudden you're saying, well, I've got, this thing that's going to hopefully appreciate in value. It's a Lafitte, Rothschild, whatever. And then later down the line, this thing gets cashed out. So people are doing this, and it's representing hard assets, and they say it's an exempted security because it fails the Howey test. There's no one person's effort. It's being relied upon in order to be able to essentially monetize your investment. So they say, well, it's not a security, and therefore it's exempted from the securities laws. Maybe. I guess it's true. I don't know.
Well, they are. I mean, also too, you're taking physical delivery of the wine at some point. You're not just buying the future.
No, you buy it for an investment because you can't afford to drink it.
It's true. No one ever drinks a bottle of 1961 Chateau Lafitte.
Somebody's drinking it. It's just not me.
Do you remember a few years ago, actually, at a Sotheby's, I think it was a Sotheby's or a Christie's auction, one of the assistants actually broke a bottle of wine from the early 1800s that was being auctioned for 50,000. So what they did was they got a strainer and they offered it to people. They basically offered it to the people in the room, saying, we're not going to be able to sell this right now. Thank God we have insurance, but let's at least taste it. And apparently this stuff had gone to vinegar 100 years ago. I mean, it was awful. I mean, they had to throw it all out. So you don't even know what you're getting sometimes with these things. A great book, by the way, if you're interested in wine, is The Billionaire's Vinegar. It's a famous book about this. They found some bottles of wine in Paris years ago that they thought was from Thomas Jefferson's cellar because it looked like it had his initials on it. Thomas Jefferson was ambassador to France in the late 1790s. And he lived in Paris, and this was like near where he lived. So there was some speculation that this was part of his personal wine cellar, and it created an incredible speculative fury. The other book that you really have to read, and I can't remember the author's name, I think it's Adams, is Extraordinary Delusions and the Madness of Crowds. Especially if you are a cryptocurrency fan. I mean, I see no difference between what's going on with cryptocurrency now and the tulip mania of the 1600s and the the South Seas bubble of the early 1700s. I see no difference between these things. I mean, they're not, in each case, you've got something that is not, that has no real value outside of its speculative value as an investment. And when that happens, you have asset bubbles. Charles Mackey, thank you. Extraordinary Popular Delusions and the Madness of Crowds is the title. It's a classic. It was written in the 1880s or 1890s, and it's just as, the information is just as valid as when it was first published. One of the few books on investments that really has stood the test of time. So thank you again, Professor Len, and thank you all for listening to a lawyer babble on about some technical stuff here. I find the legal issues of fintech just incredible right now. I mean, we're settled areas of the law that have been around for hundreds of years are all being upended by technology in many ways. And this is a classic example of how this is all happening. When I was in law school, we had no question about whether something was a deed of title or whether something was a trademark or whether something was a copyright. Now we've got these new instruments that partake of elements of a lot of different things. And it's going to be a while before the law, the law is always behind technology. That is always the case. We're always a good 10, 20 years behind where technology is. But I think it's going to take a little longer before we can resolve definitively, well, how should an NFT be treated legally? How should it be done? If two people are claiming interest in the same artwork, but one has the NFT and the other one doesn't, who wins? Those kind of things, we don't know yet how those kinds of disputes are going to be resolved. It's going to be fun. And I hope I'm around to see some of it. I mean, I'm kind of getting on in years. I'm kind of circling the drain right now. But I'm kind of hoping that I'm around long enough to be a part of this discussion and hopefully maybe shape it a little bit, and maybe see if we can predict which way the law is going to go. And then I can make some real money instead of editing law books for a living.
So before you go, I wanted to just make an announcement. On the 29th, 6/29/21, we'll have Kim Lisa Taylor. She is the principal in syndication attorneys, and she's going to come and tell us all about Reg D and PPMs and that sort of thing. So Cliff, I thank you very much. Great presentation, and I hope to see all of you next month.
Thank you, Professor. Enjoy the rest of your night, and a happy Memorial Day.
Thank you. You too.